Welcome back, guys. Today we will talk about the flow of money in the market, and we will introduce the professionals, hedger, and institutions who mainly move the market. We will explain the differences between volumes and open interest, and we will go into the first details of reading the money charts. As I told you before, we consider the price of an underlying as the effect of the movements of money in the market. Therefore, as the money moves the price, we have to read the money. How do we define the money in the market? It is the interest of operators in a certain financial instrument at a given price. We must, therefore, go in depth over the concepts of volumes, open interest, and who are the market professionals who move the money. Let's start by explaining what volumes are. Volumes are the quantity of contracts traded in a session, and we can consider them as the gossip of the market. The only information they give us is that there was an interest between two opposing parties at a given price level, and they have finalized a contract. However, we do not know if the trade took place to open a new position or to close an existing position, or if the contract was opened and closed within the day. But at the end of the day, this volume could have increased, decreased, or not affected the overall risk at all. In this chart you can see the amount of contracts traded in a day on puts and calls at the different strikes. Put in red and call in green. Open interest, unlike the volume, represents instead the facts or the substance of the market. A volume is finalized in open interest only when the stock exchange closes. The open interest is a fraction of the total volume. They are the money that remains in the market at the end of the day. It is important to remember that by definition open interest can only be calculated when the exchange is closed. Open interest is the result of the money of an operator who bought and another who sold. It is the measure of the overall risk that moved the market. Open interest is the money that is still left over the table of a financial asset at the end of the day. We don't care if a single contract has changed hands 50 times. What we are interested in knowing is whether that contract has remained or exited the market at that strike price. We care where the related money is and the related risk has stopped or is still there. In this figure you can see the distribution of open interest of call options and put options for each strike on an expiration date. The higher the value of the open interest at a strike, the more the interest and the money at that particular strike. I am sure you have understood. So, let's add further details. Every contract traded on the options market requires the interaction of two counterparties, one to buy and one to sell. Let's fix a very important concept. If I sell a call at a certain strike, there is necessarily someone else who buys the same option. For someone who sells, there is always someone who buys. So there is no open interest that is only sold or only bought, but as for volumes, it is a match between two counterparties who agree on a price. We must remember an important detail in reading the money flows. Since the buyer of the call has a right, and not an obligation, to buy the underlying, his maximum risk is represented by the cost of the call itself. Instead, the seller has a strong interest in retaining the premium. He collected the premium and he exposed himself to unlimited risk. So his objective is to keep and defend the premium with all the tools available, like the hedging and rollover techniques. Therefore, it is wrong saying that open interest is just a bunch of sold contracts in the option market. Reading them as sold makes sense from a practical point of view, as the sellers are greatly more active on the market because they have to defend the premium they collected. But who are these operators? The first category is represented by the large financial institutions like fund managers, asset management companies, banks, etc. These investors manage an equity portfolio, they hold positions on the underlying stocks, and they use derivatives to hedge their position according to their market and risk expectations. Let's see what happens. We are in a strong and lasting trend. The prices on the stock market are rising. Well, the rise is fueled by the construction of equity portfolios by institutional investors. They also offset some profits by buying OTM put options for hedging or to reduce the overall risk of their positions. In fact, as they hold the underlying, they buy the protective puts, and this results in a synthetic long call position. Yes, this is obviously an example. This position can be completely above zero if the protective put is bought when the equity portfolio is already in profit. You give up a portion of the return to ensure the total. The counterpart of the institutional is represented by hedgers, or speculators, private traders, and hedge funds of various kinds, or by those who follow market opportunities. All of them are sellers of options. For example, in an uptrend they will tend to follow the market by progressively selling puts to institutions to take advantage of the trend and speculate on option premiums. The result therefore is that, during an upward trend, the greater trading activity both of institutional and speculators will be directed generally to the put side. Institutions buy them to hedge the underlying from any downturns, speculators sell them. Well, let's get deeper. Of course, the option sellers are not stupid. If the market goes down, as they sold the puts, their portfolio goes at risk. So the sellers tend to hedge the portfolio risk whenever the price comes dangerously close to the strike price of the option sold. Speculators have their own hedging techniques. Specifically, they tend to hedge the options they sold that are mutating in the money. On distant expiration dates, the most used techniques are 2, rolling the position, or hedging with options with opposite delta. On short expiration date, traders tend to hedge risk using futures. For example, if the price approaches a put strike that could become or even expire ITM, the seller of those puts will be forced to hedge using the future. This is called delta hedging. By doing such adjustment, they transform a short put position, lateral bullish, in a short call that has the opposite setting, lateral bearish. They can correct the delta according on the amount of futures traded. It sounds easy, but it really isn't. First of all, to be a net seller, you need to have a lot of spare capital, like the insurance companies. In fact, we saw in the lessons on risk profiles what happens to the at-now curve when you are a professional option seller. What can we do then? We can analyze and view where the interests are positioned, which is part of the money chart analysis, in fact. And we do this analysis both on a static and dynamic basis. We follow the flows of money on the different strikes. Thanks for watching, see you in the next video.